So my most recent piece for the FT started with me bumping into some of the notes that I'd written 25 years ago in my last job in stockbroking when I was an internet analyst. I'd done various roles, but in 2000, the place you made the most money was covering the TMT sector, and within that, the internet stocks, and within that, any IPO, new listing on the stock market that you could find. And fortunately, the firm I worked for, Kleinworth Benson, looked after Deutsche Telekom, and they had the biggest internet company in Europe, a business called T-Online. And so in 2000, I wrote the note and did the marketing to take that company to the market. Now, looking back from 25 years on, of course, the period I did that in was the beginning of the signs of the collapse of the TMT, the so-called bursting of the TMT bubble. But actually, even in memory, I can remember it taking a long time to burst. And in fact, from the IPO price to the first day's trading, those shares went up over 40%. And so anyone who bought that deal, I say in my own defense, had plenty of time to take very big profits in it. In fact, all the rest of those stocks which ended up falling, the TMT stocks which fell a long way between 2000 and 2003, they didn't all fall overnight. You had a number of years still to take profits, because of course everyone had huge profits in 2003. So yes, the amount of your profit went down, but you had lots and lots of time to check the valuations, check whether you really thought that these shares were properly supported by valuation, take your profits and move on to other things offering better value for money. And I think that's the other point that I went back to about 2000, that although you needed to sell pretty much all of the TMT stocks, even the good ones went down with the bad ones. I mean, obviously not as much. But you didn't have to sell out of equities entirely. There were plenty of other shares in other sectors which are still perfectly good value for money. In fact, fortunately, when I moved on into the fund management business, working with Niels Torb in 2000, I was selling the stocks that I'd sold him as a stockbroker 3 years ago and still taking very good profits. And then Niels was saying, why don't we buy some of these mining companies? They're completely the other end of the market. They're trading on half book or half the cost of developing these mines, so offering deep value rather than growth hopes. And indeed, the mining shares that we bought, at that point we bought a company called Edelsten, which is now part of BHP, the bulk of BHP. We were buying it for half the value of its mines. And obviously we made huge amounts of money out of that. And that share had done nothing but go down while the TMT shares were going up. So just because you see a bubble in the market doesn't mean to say that you have to bail out of all equities. You can normally find other equities to move into. And the ruling principle here and the discipline that you have to apply, even if you think there's a bubble, is just sell the shares which are overvalued and keep looking for shares which aren't overvalued. If you try to do it top down and call the top of the bubble, I can't really offer you any advice on timing on that. I think it's a sort of journalist way of looking at things. I think it's too top down, or an economist way of looking at things. Whereas for a fund manager, we try to do things bottom up. If a share's expensive, sell it. If a share's cheap, buy it. And that way, you don't have to call the top of a bubble. You just sell expensive shares, buy cheap ones, and you work your way round it piece by piece, and you find, oh, goodness me, I used to own a lot of TMT shares, now I don't own any because they're all expensive and I've sold them. But you sell them one by one and buy the other shares one by one. And we think that the current situation is really pretty similar. So over the last couple of weeks, now speaking on the day after bonfire night, so we've just had the results season for the Magnificent Seven, the big American technology shares, and last week, lo and behold, some of them look very expensive and the market's very concerned about their cash flow. So Meta fell quite sharply. They're the company that runs Facebook and WhatsApp. There's nothing wrong with the core business there at all. It's generating lots and lots of cash flow from its advertising. But the market's getting increasingly worried about how much capital investment they're spending on AI, and it's certainly not a foregone conclusion that capital will get a really good return. And so those shares were off quite sharply on the results, and we've sold our position in that. While Amazon shares, which reported, I think, on the same day, showed that AI was driving very good growth in their cloud business. So they're getting more than enough money in from the cloud business, AWS, to justify what they're having to spend on AI. And so their shares went up. So again, follow the cash flow, look at the valuation. In one case, the market's quite worried, the shares go down. The other case, the market's not worried, the shares go up. But you have to do the analysis stock by stock. And then meanwhile, yes, we are ending up selling more tech companies than buying tech companies. And in fact, we've generally been selling tech companies all year, often too early, but I have 25 years of experience of selling stocks too early, and I don't regret it at all. It's much better than selling stocks too late. Because again, in the rest of the world, in the sectors a million miles away from the AI boom, there's really good value for money. And so as an illustration, with some of the money that we've raised, where we've taken profits in our technology companies recently, we started a new position in a company about as far away from AI as you can get. Very well-known business called Nestle, which basically makes coffee, chocolate, and pet litter, which are incredibly reliable businesses, fairly low growth. They're very resilient if there's ever inflation, because they've got very good brands. I'm afraid, if inflation comes back, which is something the market isn't so worried about at the moment, but we all know that that is the main enemy of your wealth. If governments decide they've got so much debt, they can't do anything else but let inflation quietly run riot. We always want to have a number of stocks in the fund which will do well when, or do better than other companies, cope better than other companies if there is a bit of inflation. And Nestle is an absolute classic for that in terms of being able to, having pricing power in things like Nescafe and those little rather expensive coffee, little plastic cups of coffee that you put in your Nespresso machine. I'm afraid if they put the price of them up, I'm afraid most people are going to just take that price increase and swallow it. And in terms of value for money, in 25 years, I've never seen Nestle so cheap. They've had some management arguments recently. They've got rid of a chief executive, got a new one in. But just as an illustration, their stock yields nearly 4% in Swiss francs. Now, Swiss francs, rather strong currency compared with sterling, and 4% yield in a company which can cope with inflation, for me, suggests that, that is an absolute classic long-term place to put some of your wealth, particularly if you have a defensive mindset or a cautious mindset. And the fact that it's completely out of favour, completely unloved, because there's so much, all the love has gone to the AI stocks and the tech stocks, does suggest this is a sensible way in which we can take one more step away from the hottest part of the market towards the parts of the market where people which people are ignoring. And that way you end up with a good balanced portfolio without feeling that you have to give up on equities entirely or panic. Just take it step by step, follow the valuations, and keep a balanced portfolio. That would be my advice at the moment.
The content of this video is provided for information purposes only and is not intended to be an offer or solicitation, nor is it intended to be investment advice. The funds run by Goshawk Asset Management may have positions in any of the stocks discussed, but their inclusion in this video should not be taken as a recommendation. Historical performance information is presented by way of example only, and this video may contain forward-looking information that is not purely historical in nature, with no representation made that the performance presented will be achieved and no guarantee that any forecast will come to pass. Reliance upon information in this video is at the sole discretion of the viewer. It is not intended to be relied on in making or refraining from making any specific investments or other decisions. Opinions expressed, whether specifically, in general, or both, on the performance of individual securities and in a wider economic context, represent our view at the time of preparation and are subject to change. We hope that's helpful.